China's debt crisis. A nation drowning in financial despair. In the heart of Shenzhen, a man stands before a camera, his voice trembling as he reveals a devastating truth. I'm bankrupt. I owe 4 million RMB, and my marriage is in ruins. Another voice chimes in, heavy with resignation. I'm worse off 7 to 8 million in debt, labeled a discredited defaulter. My assets frozen. Their stories shared on social media are not isolated tragedies, but symptoms of a broader catastrophe engulfing China. By the end of 2024, a staggering 837 million adults, 73% of the population, are burdened with debt, according to the 2024 China Residents' Financial Debt Status Report. From frozen bank accounts to shattered dreams, the nation's economic miracle has morphed into a nightmare of insolvency, affecting everyone from young professionals to retirees. This report explores the crushing weight of China's debt crisis, its roots in systemic failures, and the fragile hope offered by emerging bankruptcy reforms. A nation in debt. The scale of the crisis. The 2024 China Residents' Financial Debt Status Report, compiled from a survey of 350,000 households across 31 provinces, paints a grim picture. As of December 31, 2024, 837 million adults are in debt, meaning nearly 3 in 4 Chinese citizens are grappling with financial obligations. Of these 625 million, 74.7% of debtors are juggling multiple types of debt, including mortgages, car loans, credit cards, consumer loans, and business loans. This multi-layered burden has pushed households to the brink, with many unable to keep up with payments. Mortgages are the heaviest load, with 482 million people, 57.6% of debtors struggling to pay for their homes. Credit card debt follows, affecting 375 million individuals, while consumer loans burden 293 million, car loans, 187 million, and business loans, 92 million. The average credit card debt per person stands at 52,000 RMB, with 30 million accounts overdue by 8%. Online loans are equally perilous, with 20 million people defaulting on loans, carrying annualized interest rates, often exceeding 24%. These numbers reveal a society trapped in a cycle of borrowing, with many using one loan to pay off another, spiraling deeper into financial ruin. The crisis disproportionately affects certain groups. The 25 to 40 age bracket faces the highest debt rates, with 85.7% in debt, peaking at 91% for those aged 30 to 35. This generation, born between 1990 and 1995, is drowning in financial obligations as they navigate careers, home ownership, and family life. The 41-55 age group follows at 73%, while 23.5% of those over 65, mostly retirees, still carry debt, a troubling sign that financial burdens persist into old age. Geographically, first-tier cities like Beijing and Shanghai report the highest debt rates at 76.8%, followed by new first-tier cities, Hangzhou, Chongqing, Wuhan, Chengdu, at 72%. Second-tier cities have a 65.7% debt rate, while third- and fourth-tier cities and rural areas lag at 53% and 41.6% respectively. Wealthier regions bear heavier debt loads, reflecting the high cost of urban living and easy access to credit. Education and occupation also play a role. Those with a bachelor's degree or higher face an 82% debt rate, compared to 43% for those with a high school education or less. This suggests that higher education, while a path to opportunity, often comes with significant financial costs. Civil servants and public sector employees, seen as low-risk borrowers due to stable incomes, have the highest debt rates at 86%, followed by white-collar workers, 81.5%, professional technicians, 79%, and small business owners, 65.4%. Blue-collar workers and migrant laborers with less access to credit have lower rates at 48.7% and 31% respectively. The ratio of total debt to disposable income has surged to 64.7% by the end of 2024, nearly doubling from a decade ago. This means that nearly two-thirds of a household's disposable income is consumed by debt repayments, leaving little for savings or discretionary spending. The non-performing loan rate for personal loans stands at 3%, with credit cards and consumer loans showing the highest delinquency rates. Alarmingly, only 23% of debtors understand the long-term impact of overdue payments on their credit scores, leaving millions vulnerable to lasting financial consequences. Economic collapse and industry meltdown. China's debt crisis is inseparable from its economic downturn, which has deepened since the COVID-19 pandemic in 2020. The real estate market, once a pillar of growth, has collapsed, with property prices in cities like Hangzhou dropping by half. High local government debts, slowing exports, and escalating U.S.-China trade tensions have further eroded economic stability. The National Bureau of Statistics reports that over 9 million food and beverage businesses operate in China, but 2 million closed or lost licenses in 2024, up from 1.4 million in 2023. Informal operations like street vendors are shutting down at untrackable rates, signaling a broader collapse in small-scale commerce. In Zhejiang, a hub of private enterprise, the crisis is acute. In January 2025, Zhongchong Group, a major construction firm, ranked 242nd among China's top 500 private enterprises, was auctioned off by the Zhejiang Property Exchange. The same month, Ningbo's five-star Risen Plaza Hotel entered bankruptcy proceedings. In April, Wenzhou's Dongji Garment, a prominent apparel brand, collapsed. Small and medium-sized enterprises, especially those in foreign trade, are closing en masse, battered by the U.S.-China tariff war. A Wenzhou factory owner lamented, "We've invested heavily in equipment, but orders are gone. We might last 3 years, but I'm not hopeful. The human toll is devastating." A Hangzhou businessman facing 10-20,000 RMB monthly expenses for his mortgage, car loan, and child's tutoring decided to leave the city with his wife. "We can't afford hot pot anymore," he said. "Property prices crashed, so selling our house won't cover the debt. It's better to return to our hometown and build a house for a few $100,000. His story reflects a growing trend: urban residents fleeing to rural areas where debt burdens are lighter. Yet even there, financial pressures persist as savings dwindle and opportunities shrink. The social and psychological fallout. The debt crisis is not just financial, it's tearing apart lives and communities. Social media is flooded with stories of despair. One man labeled a discredited defaulter shared, "My WeChat bank cards and Alipay are frozen. I'm in court, and my assets are gone." Another described the collapse of his marriage under the weight of 4 million RMB in debt. These personal tragedies highlight the psychological toll of financial ruin. "I'm anxious every day," said a Nanjing shop owner. "I worry about layoffs, pay cuts, and losing everything." Public frustration is palpable. Online netizens reject claims of high per capita incomes, arguing that after mortgages, loans, and daily expenses, most have nothing left. "People aren't refusing to spend," said a Shanghai resident. "Our pockets are empty." The contrast between official narratives and lived realities fuels distrust. The central government's decision to raise salaries for 48 million public sector workers by 500 RMB monthly, costing 12 to 20 billion RMB, has sparked outrage. Meanwhile, Zhejiang's public sector faces 50,000, 100,000 RMB annual pay cuts due to a 25% drop in land sale revenues, exposing stark regional disparities. Government debt and policy responses. The Chinese government's own debt crisis exacerbates the problem. By 2021, China's macro leverage ratio reached 304%, with households at 62%, non-financial enterprises at 114.8%, and government departments at 127%. Local government debt at 106.6% of GDP dwarfs central government debt, 20% of GDP. To address this, the government plans to issue 10 trillion RMB in low-interest bonds from 2024 to 2029 to replace high-interest hidden debts. In 2025, local government special bonds will increase to 4.4 trillion RMB to fund profitable projects and reduce hidden debts. Yet fiscal revenues are declining, and these measures have failed to stem the tide of worsening debt. The government's push for personal bankruptcy laws is a desperate attempt to manage the crisis. In March 2021, Shenzhen introduced China's first local personal bankruptcy regulations, allowing residents who have paid Social Security for over 3 years and are unable to repay debts to apply for bankruptcy proceedings reorganization or settlement. After 3 years of strict behavioral restrictions, they may receive debt relief. By September 2024, Shenzhen courts processed 2,750 applications with 1,215 under review and 358 accepted. In the first 5 months of 2025, 583 cases were accepted with projections of 1,200 for the year, a sharp rise, but a drop in the bucket compared to the millions in need. In April 2025, Xiamen launched a similar pilot program, including provisions for inheritance joint couple bankruptcy and merged individual corporate bankruptcies. To qualify, applicants must not be government employees, must have income sufficient only for family support, and must not intentionally evade debts. These conditions aim to prevent abuse by wealthy defaulters. Yet the system's limited scope, confined to pilot cities, offers little relief to the 30 million overdue on credit card debt and 20 million defaulting on online loans. Shenzhen's program is a start, but it's not enough, said a Beijing economist. It needs to go nationwide. The role of systemic competition. The debt crisis is rooted in China's hyper-competitive economic system, shaped by the Chinese Communist Party's CCP authoritarian policies. Businesses prioritize outlasting rivals over innovation, leading to a zero-sum game where companies lose money to undercut competitors. Small businesses unable to compete are driven out while survivors raise prices, exploiting consumers. The CCP supports this dynamic, backing large firms to dominate global markets where they replicate destructive competition. This system crushes the little guy, said a Guangzhou entrepreneur. The CCP benefits, but we pay the price. The food and beverage sector exemplifies this. With 2.2 million businesses closing in 2024, small restaurants and vendors are collapsing under debt and competition. I can't compete with platforms offering 0 yuan meals, said a Chengdu cafe owner. They're killing us to win market share. The real estate crash has also left developers and homeowners in limbo, with millions unable to sell properties at a profit. My house is worth half what I paid, said a Shanghai resident. I'm stuck with a mortgage I can't escape. A path forward. The push for personal bankruptcy laws is a pragmatic move to avert social unrest. The collapse of P2P lending platforms in recent years sparked protests, and the government fears mass defaults could ignite similar uprisings. By offering a legal path to debt relief, the CCP hopes to diffuse tensions. Yet the system's strict requirements and limited rollout exclude many in need. I don't qualify because I'm a civil servant, said a Hangzhou teacher. But I'm drowning in debt too. True recovery requires dismantling the toxic competition fostered by the CCP. A fairer market with stronger regulations and less emphasis on cutthroat rivalry could ease the pressure on businesses and households. We need a system that rewards quality, not just survival, said a Nanjing economist. Without reform, the debt crisis will deepen, pushing more families into bankruptcy and eroding trust in the system. Voices of the crisis. The stories of ordinary Chinese citizens underscore the crisis's human cost. A Xi'an factory worker laid off after his company collapsed said I owe 1 million RMB and can't find work. My kids are hungry. A Beijing retiree still paying a mortgage at 70 sighed. I thought retirement would be peaceful. Now I'm broke. A young Shanghai professional juggling credit card debt and a car loan admitted I use one card to pay another. I'm trapped. These voices echoing across social media and court filings reveal a nation on the edge where financial despair threatens to unravel the social fabric. As China grapples with its debt crisis, the path forward is uncertain. The government's reforms offer a glimmer of hope, but without systemic change, the cycle of debt and bankruptcy will persist. For millions, the question is not just about financial survival, but whether the system itself can endure the weight of its own failures. The stories of frozen accounts, broken marriages, and shattered dreams are a stark reminder China's economic miracle is fading and its people are paying the price.